I'd now like to turn to monetary policy, which has played an important role in building the bridge that I spoke about earlier. The RBA's actions have led to the lowest funding costs on record, a banking system that's flush with liquidity and very low bond yields. Our actions have also meant that the exchange rate is lower than it otherwise would have been, and they've helped strengthen household and business balance sheets. And this has been our contribution to the recovery in jobs and economic activity in Australia. At the Reserve Bank Board's next meeting, we have two important decisions to make. The first is whether or not to extend the yield target from the April 2024 bond to the next bond, which matures in November 24. And the second is whether and in what form to extend the bond purchase program once the current program is completed in September. The 3-year yield target was introduced in March 2020 during an exceptional period. Our judgment is that it has been a successful monetary policy response which has helped keep funding costs low and reinforced our forward guidance about interest rates. At the time the target was introduced, the 3-year government bond had a maturity date in early 23. At that time, the board recognised that the pandemic would require an extended period of very accommodative monetary policy. Reflecting this, the board's view was that the probability was extremely low that the conditions for an increase in the cash rate would be met within 3 years, and adopting a 3-year yield target reinforced that message. Now, with the passage of time, the 3-year government bond has a maturity date of April 24, and a few months' time the maturity date would move to the November 24 bond. In considering whether or not to extend the target to the November 24 bond, the central issue is again the probability of the cash rate increasing over a 3-year window. In this context, the board has reviewed a range of possible scenarios. In some of these, the conditions for an increase in the cash rate could be met during 2024, while in other scenarios these conditions would not be met. And the board will again review these scenarios at our meeting in a few weeks' time. The bond purchase program has also been an important part of the RBA's monetary policy response. By purchasing bonds, we've lowered bond yields and funding costs across the economy, and we've contributed to a lower exchange rate than otherwise, and this has helped the rural sector. With the current bond purchase program to be completed in September, the board has been working through a range of options for what comes next. These options include, first, ceasing the bond purchases in September. Second, repeating the current $100 billion purchase program over a similar timeframe to that of the current program. Third, scaling back the amount purchased or spreading the purchases out over a longer period. And fourth, moving to an approach where the pace of bond purchases is reviewed more frequently based on the flow of data and on the economic outlook. We've made no decisions yet, other than to rule out the first option. That's the cessation of bond purchases in September. The RBA's bond purchase program is one of the factors that's underpinning the accommodative financial conditions necessary for the economic recovery. So it would be premature to be considering ceasing bond purchases in the near term. The key consideration here is how the RBA can best support the ongoing recovery of the economy. The board wants to see the recovery transition into strong and durable economic growth, with low unemployment and faster growth in wages than we've seen recently. Over time, this will help deliver the inflation target. As part of the board's overall strategy, it will not increase the cash rate until inflation is sustainably within the 2 to 3% target range. Year-ended CPI inflation will temporarily spike in the June quarter to around 3.5% due to the unwinding of some pandemic-related price reductions. There have also been price increases for some items due to pandemic-related interruptions to supply. But beyond this, Inflation pressures remain subdued, and they're likely to remain so. For inflation to be sustainably in the 2 to 3% range, wage increases will need to be materially higher than they have been recently. Partly for the reasons I talked about earlier, this still seems some way off.